Hello, in today's video we're going to talk about multiple revenue streams. Most people rely on one income source. That source is usually a paycheck. They work, they get paid, they pay bills, and then they wait for the next paycheck to come in. There's nothing wrong with having a 9-to-5 job. In fact, earned income is often where wealth building often begins. But if your entire financial life depends on one income source, you need to rethink your overall financial plan for the long term. If a paycheck stops, your life gets harder. Wealthy people tend to think differently. They do not just ask, how can I earn more money today? They ask, how can I build income sources that can keep compounding over time? Let's go ahead and jump right into the video. The first source of income is earned income. The first income source is the money you make from active work. Examples include your salary, commissions, bonuses, consulting, freelance work, overtime, and side jobs. For most people, earned income is the starting point. This is the money that pays the bills. It covers food, housing, transportation, insurance, and everyday life. Earned income is usually what funds the other income streams. If you want to invest, you need cash. If you want to start a business, buy real estate, pay down debt, build an emergency fund, or improve your financial foundation, earned income is the starting point. The goal is to use your 9-to-5 job strategically. Increase your skills, increase your value, increase your income, then use the gap between what you earn and what you spend to build assets. Second, let's talk about business income. This comes from owning a business. Examples include an online business, a local business, an agency, a coaching business, e-commerce, a consulting company, just to name a few. Business income is powerful because it can eventually scale beyond your personal time. At first, most businesses are not passive income. They are very active. You're doing the sales, you're serving the customer, you're handling operations, you're fixing problems, and you continue to learn. You're learning the market. But over time, a business can become more valuable when you build systems. That means process, your templates, your employees, contractors, software, automation, content, distribution, and repeatable workflows. A job pays for your time. A business can pay you for the systems that you build. Always remember, business income can be unstable. Revenue can go up and down. Customers can change. Expenses can rise, and competition can increase. But when built well, business income can create cash flow, equity value, tax planning opportunities, and long-term control. This is why many wealthy people either own businesses, invest in businesses, or build careers where they eventually get ownership. Ownership changes the game. Third, we've got investment income. Examples include stocks, ETFs, mutual funds, index funds, bonds, money market funds, brokerage accounts, and retirement accounts. Investment income matters because it gives your money a job. Instead of only trading your time for dollars, you're putting money into assets that grow over time. A stock represents ownership in a business. A bond represents lending money and receiving interest. An ETF can give you exposure to a basket of investments. An index fund can let you own a broad part of the market. The key word here is ownership. Wealthy people tend to own assets. They own businesses, they own stocks, real estate, private investments, and intellectual property. Now, the average person focuses only on one income. Wealthy people focus on income and ownership. Investment income can come from interest, dividends, capital appreciation, and compounding. As always, you want to do your own due diligence. You got to remember that your money will make more money than you will, but you always have to take time and do your own homework on your investments. Josh Sozer Investments, we're a big believer in owning stocks and real estate. You got to learn how to evaluate businesses correctly. The Intelligent Investor is a great book to read when you want to learn financials of a company and how to evaluate properly. We always recommend owning growth stocks with great CEOs such as NVIDIA and Eli Lilly. You want the number one stock in that sector. You always want to basically, you want to own the best. But really, you want to make sure the financials are in order. Always check the PE, forward PE, EPS, dividend. Those are all keys. And making sure that you agree with the CEO, because the CEO decides the overall strategy for the company. Now let's discuss number 4, dividend income. It's the fourth source. Dividend income comes from companies that share part of their profits with shareholders. We at Josh Sozer Investments just received our dividend from NVIDIA. That's been our number one company for a long time. You always want, always got to remember that, you want to do your homework and check a few reasons why owning a dividend is attractive, because it can create recurring cash flow without selling the asset. But you always got to remember that dividends are not guaranteed. A company can reduce a dividend, a company can pause a dividend, a company can eliminate a dividend completely. You always want to ask these questions. Is the company profitable? Is the balance sheet strong? Is the payout ratio reasonable? Is free cash flow healthy? Is the business stable? Does the company have a history of maintaining or growing the dividend? Could the dividend survive a recession? Now, dividend income can be useful, especially for long-term investors who want cash flow. Always remember, dividend quality matters more than dividend size. Fifth, let's talk about real estate income. This usually comes from owning property. Examples include rental houses, duplexes, apartment units, commercial properties, storage units, land leasing, and REITs, just to name a few. Real estate can build wealth in several ways. You may receive rental income. The property may appreciate over time. Your tenants may help pay down your mortgage. You may benefit from tax advantages. You may use leverage to control a larger asset. But you got to remember, real estate is not automatically passive. There are vacancies, there are repairs, there are property taxes, there's insurance, interest rates, unexpected repairs, just to name a few. So you always have to consider the big picture. If you're buying property, you want you want to just not only focus on buying correctly, but also your exit strategy. Anytime with any investment, whether it's real estate or stocks or anything else, you want an entry point as well as a exit strategy already set up. Being prepared is the key to success. You always got to remember that there's tons of things to factor in. There's local market risk, as well as the other things we just went over. And this is why the numbers matter. Before buying a rental property, you need to understand cash flow, cap rate, debt service, maintenance reserves, vacancy assumptions, insurance, taxes, and your true return after expenses. Real estate works best when the numbers work. You always have to figure everything out. An hour's worth of planning is a day's worth of work. A property can look good and still be a bad investment if the math does not work. Wealthy real estate investors, are not just buying houses, they're buying cash flow, location, financing structure, and long-term optionality. Next, let's go over number 6, royalty or intellectual property income. This is income from something you create once and can sell or license repeatedly. Examples include books, courses, music, templates, software, digital products, paid newsletters, licensing deals, prompt packs, online education, and membership communities. This is especially important in the digital economy. Your knowledge can become an asset when you package it clearly and solve a problem. For example, Someone may create a budgeting spreadsheet, a real estate calculator, a course, a book, a content template, or a software tool. At first, it takes active work. You have to create the product, you have to understand the customer, you have to build distribution, you have to improve the offer, you have to earn trust. But once the asset exists, it can potentially be sold repeatedly. Digital products still need marketing, updates, customer service, and quality control. But intellectual property is powerful because it separates value creation from hourly labor. You're not only getting paid for time, you are getting paid for packaged knowledge, creativity, or systems. This is one reason content businesses are so interesting. Content builds trust, trust builds distribution, distribution creates opportunity. Opportunity can become products, services, partnerships, and business income. Seventh, let's discuss capital gains. A capital gain happens when you sell an asset more than you paid for it. Examples include selling a stock at a profit, selling a rental property at a profit, selling a business, selling land, selling private investments, selling collectibles. Many wealthy people build net worth through asset appreciation. They buy or build assets, hold them, improve them, and eventually sell them at a higher value. This is different from monthly cash flow. Dividends are cash flow. Rent is cash flow. Interest is cash flow. Capital gains comes from selling an asset after it has increased in value. But you got to remember, capital gains are not guaranteed. Asset prices can fall, markets can change. Taxes can reduce your final return. Bad timing can hurt results. Overpaying can destroy returns. That is why valuation matters. You got to remember, the price you pay, matters. Wealth is often built by owning good assets for long periods. Really, you want to make sure that you buy quality assets. Now, here is the key. You don't necessarily try to build all 7 income sources at once. A practical order for many beginner investors is, first, increase your earned income. Second, control spending. Third, build emergency savings. Fourth, pay down high interest debt. Fifth, invest consistently. Sixth, build business or side income. Seventh, add real estate, dividends, or digital assets over time. We at Josh Lozer Investments encourage and buying, growth stocks that pay some sort of dividend. That's key. You always want your money working for you. This order matters because your financial foundation matters. You always want to build the foundation first, then build assets, then build systems. So let's go over it real quick. The 7 income sources that rich people have are earned income, business income, investment income, dividend income, real estate income, royalty or intellectual property income, and capital gains. The key lesson here is wealthy people do not rely on one source of income. They use active income to build assets. They use assets to create cash flow. They use systems to create scale. They use long-term ownership to build net worth. So remember, you want to just go ahead and start with where you're at today and increase your income, control your spending, build your financial base, invest consistently. The FIRE movement is a great movement. You always want to invest as much as possible. Some people invest as much as 50% of their earned income, and you can retire within 10 years. Then next, add more income streams with discipline. The goal is durable wealth. You don't all, a bunch of stress on your money. So I know you got bills and everything. So basically, you want to make sure that you work a job that's consistent. That you have everything pre-planned and you're on the same page with everyone you work with, as well as any business partners you might have. That's key to long-term success. If this video has helped you, subscribe to Josh Slozer Investments for clear, practical education on money, investing, business, and long-term wealth building. Our goal here is to create generational wealth. Appreciate everyone watching this video. Come back next week to check out our latest video. I hope everyone has a very profitable week.